Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to do a battle between Chevron and Exxon, the two behemoths in the oil industry. Oil has been recently rocked. We're going to take a look at 9 years of historical financial information for both of these companies, figure out what free cash flow they each yield, how much we can earn if we hold these companies over a decade, figure out which one is the better stock to hold. You ready to get to work? Okay, before we dive into these two stocks, let's review the 5 key attributes that we use when we value any security on this channel. And those are top line revenue growth, you've got to have it. Earnings growth, we look at EBITDA, it's enterprise level earnings. We want to see that growing. We want strong free cash flow, we want low debt, and we want a well-priced stock so we can buy it at a reasonable price and hold it for a long term where we get our economic return. Behind me is the 9 years of historical financial information for Chevron Corporation. 2012, $222 billion of top-line revenue, and that has declined to $94 billion in revenue. And largely, oil has fallen in price. The crude oil has fallen in price over this long period of time. There's about $100 a barrel in here, and then the 60s in here, and then it tanked, absolutely went to zero in the front month forward curve for I think it was October of last year. But it's rebounded significantly. It's about up to $60 a barrel in crude. So I'd expect revenue to be in this range next fiscal year. But this is revenue. I can't necessarily say it's growing over the long term. Unfortunately, it's not. But we know because of oil is declining, that's why. EBITDA is profitable every single year. So they are able to operate in a commodity business and not lose money in a particular year, which is, kudos to them for being able to do that. But again, it is declining, not only just because of this recent year, but over time it is pulling back. Debt, they do have some debt, not insurmountable given how much EBITDA they have. So if I measure earnings relative to debt, again, you pay debt with earnings, so you need to have positive numbers here to pay this debt back, much like a mortgage that you might have versus income, or earnings that you have as your income. So they use this to pay this, and they're roughly 1-to-1, which is nice to see. If we continue going down the stack on enterprise value, you've got some excess cash on the balance sheet that's gone now recently because the weak fiscal year as a result of the drop of oil. And then market cap. Market cap is the number of shares outstanding times the average price. You've got $212 billion, and it's come down to $157 billion as of the last fiscal year. It's bounced back up as oil stocks and oil has rebounded. So the company's actually come back off that low. But you can see over time, it has come down a little bit. And then I add all that up, subtract the excess cash, and I get enterprise value. And enterprise value is exactly what the business should be valued at. It's the total value. I like to use the analogy of a home price. If you think of the retail value of a house on the market, the house is not the market cap. The house price is the enterprise value of the house. If you buy it and you finance it, then you put equity down, which is market cap. That would be the equity piece. And you go to the bank, you get a mortgage, which is the debt piece. So when you look at a retail price on a house, that is the enterprise value. That's the same thing with a stock. The retail price of stock should be its totality, which is its enterprise value. It's just made up of a combination of debt and equity because most companies have debt on the books. So they subtract the debt from the equity and you get market cap. Okay, but let's take a look at some of these valuation ratios. So enterprise value, so total value of the business divided by EBITDA. EBITDA is earnings. So this is like a payback period, right? If I produce earnings of EBITDA of $20 billion every single year and the business is trading for 200 billion and I divide the two, I get a 10-year payback. That's what this is trying to say. If I bought the company today and it's producing, let's see what it was producing, $14 billion every single year, and I paid $200 billion for it, that's a 15-year payback. Now, obviously, they're expecting the earnings to rise, so that was not historically accurate. It has been a lot less than that historically. So 9, 7, got a little high in here. 6 and 5 is kind of the range. So this is like a 10x long-term average. I'll delete this. It's like a 10x long-term average enterprise value to EBITDA ratio. So it's trading a little high from that right now because obviously it was expected earnings to rebound, which they have. Net debt to EBITDA, this is our measure of a risk of bankruptcy. If you're an equity owner, you're buying the stock. If the stock were to if the company were to go in financial trouble and go bankrupt, and you had to go to the court to get your money back, the judge is going to say, okay, let me see all the creditors, all the people who lent you money, they get their money first, and then after all those people are paid, the equity owners get anything left over. So the more debt that's in front of you as the equity, the greater the risk of loss if something were to happen in the business. So we look at this measure to make sure it's less than 3 times is a standard senior debt, conservative level of debt that a bank is willing to put onto a business. We look at that as the same ratio. So I like here that we're seeing less than 1 predominantly. You can see that it was less than 1 historically. Then when earnings tanked, the ratio changed because the earnings fell but the debt remained the same. So this spiked up. Now that earnings have rebounded, this is going to come back down. So I think that passes the smell test on debt. Okay, that is revenue, EBITDA, and enterprise value. Let's switch over to Exxon Mobil and give us a shot at Exxon. Okay, behind me is Exxon Mobil, 10 years of revenue information, $420 billion. So already it's larger than Chevron, $420 billion, down to $180 billion of revenue for Exxon Mobil. So much larger than Chevron. EBITDA follows the same path. So $65 billion to $15 billion. So it's declining as oil price is declining from the 100 range. Again, 2012 to 2014, oil was about $100 a barrel. Then from 15 to 20, it was around $60 a barrel with the most recent decline and then subsequent rebound in 20 and 21. So that gives you a range. You can see when oil is about $100 a barrel, they are printing about $55 billion, $60 billion of EBITDA. When oil's in the $60 range, they're in the 30s. So their earnings definitely fluctuate with EBITDA. Excuse me, the EBITDA fluctuates with the global oil market, which is no shocker. So that's down both of those. Let's look at debt. Debt $11 billion to $72 billion. It's gone up over this period of time. Market cap $400 billion to $173 billion. So down over as oil has collapsed. And then enterprise value being the sum of these two. There's no excess cash. I get $412 billion down to almost half, $248 billion. Let's take a look at our our enterprise value ratios. The average is 11. So Exxon Mobil and Chevron on a long-term average are roughly the same. It's 1 extra turn of EBITDA, which for us, it's kind of immaterial. We're looking at long-term averages. 10 is very close to 11 in my book. High of 16 or 18 here, kind of the same pattern that Chevron had where there's kind of a peaking in these years. But this was too high above average. If I exclude those, you're looking at the 8s. 8 is kind of the long-term low point for the multiple. And then the risk of bankruptcy, our net debt. So net debt, again, is about 1 with the exception of the most recent year where debt remained constant, earnings fell, so this ratio went up. I expect that ratio to come down a little bit over time, although both companies did have to borrow money when oil did collapse. They both went into the debt market and took on a bit more debt. So now we've got both companies, both revenue is declining and EBITDA is declining. So I'm not sure those check the box for us. It's really going to be based on what we think oil is going to do is where we're going to set the price for these companies. Okay, now let's flip back to Chevron and let's take a look at the cash flow statement because cash flow is the most important. It's what all companies are valued on. And certainly in a CapEx heavy industry like oil and gas, we want to take a look at the free cash flow and not just rely on an EBITDA market multiple to judge the value. So here we go. Cash flow from operations, CFO. So I'm pulling the top third of the cash flow statement, which is my favorite statement, your favorite statement, the cash flow statement. $38 billion of free cash flow down to $10 billion, $10.5 billion as a result of the direct decline in oil. CapEx, what is that? That is money that they put back into their business every year to maintain and to grow. So think of it this way. They pump oil out of the ground. They go into the retail market or wholesale market, they refine it, they sell it, and they got $11 billion of free cash that's sitting in their checking account at the end of the year. Then the CFO and management team sees, okay, well, we ran all these oil rigs for a year. They need new tubing, they need lubricant, they need grease, they need bolts. I've got floating oil derricks in the middle of the Atlantic. I got to make sure that they don't rust. I got to put back. And then I've got to go build new oil derricks from new, the new shale oil projects that want to be mined. I have to go build out those assets. So all of that added up was $9 billion. So they had $10.5 billion in checking account. They look at the cash needs of the business to maintain and to grow. That's $9 billion. So they peel off $9 billion and say, here you go. And what's left, the difference between these two, that is what the owners can actually get. Or they have to pay debt for it. We'll get there in a second. But this is what you want to look for. Free cash flow, less CapEx. It's the true free cash, well, not true free cash flow, but it's cash that's available for the business. And it's extremely important. And we always look at this pairing between the two. How much of the free cash flow do they have to put back in the business every single year? And when I did this little ratio off to the side, I've never done this before, so just to give you some gauge here, these are actually sizable numbers. Many years, Chevron is putting more than 100% of their free cash flow back into CapEx. So they made $31 billion of free cash flow. They put back $35 billion. They made 19.4. They put back $29 billion. A lot of this is for growth, I grant you, but I do like to see businesses that can produce more free cash than they have to put back. That's just a personal preference here at this channel. And it's one of the reasons we just find it as free cash flow, or how we look at strong free cash flow. The next column is debt. So this is both inflow and outflow of debt, principal payments. So you generated cash from your business, you put money back in for growth. The last thing you have to pay is your bondholders, the people who lent you money. So then when it's all said and done, you reinvest in the business, you peel off your debt payment to the bank. That's right here. And you can see last several years it was about $5 billion. Then it's positive 6.8 because they were short. The oil market collapsed. They needed cash. They said, hey, I'm going to tap the credit market. I'm going to bring cash in. That's a large positive number. So then when I sum all these up, I get a free cash flow to equity. Now, free cash flow to equity is what the business is valued on. That's what is available to stockholders like us. This money can be used to dividend out. It can be used to buy back shares. It can be used to go make acquisitions, all of which is designed to grow or enhance the value of the stock. And that's the number we want to look at. One cautious note, because we're including debt, and because some instances that debt is borrowed and pulled in, that means that this number is much higher than it would have otherwise been. If you notice my example before, these two numbers here was basically $1 billion, $1.5 billion. This is showing $8.5 billion. That's because they borrowed 6.8. This is not sustainable. You can't borrow like that forever. So when you're looking at free cash flow, you always want to say, this is a tall number, but most of it's coming from debt, so I'm not going to rely 100% on this number if I forecast it forward. But let's keep going. Shares outstanding have been declining as they use some of this free cash flow to buy and cancel shares. That's a good thing. We want to see that. That is them taking the ownership, destroying the ownership, throwing it away, and that means the people who still own the stock, the remaining pool, have a greater owner percentage of this business. That's fantastic. I take free cash flow to equity, divide by shares, I get these numbers, which are pretty strong in here, largely, I'm guessing, because, No, actually, these are pretty strong numbers. They did pretty well there. Share price and divide by share price, I get a free cash flow yield. Free cash flow average 2.5. If I exclude the most recent year, which has the kind of anomaly, that average is 2.1. So let's take a look at Exxon. All right, Exxon's free cash flow number, they're significantly larger than Chevron, so I would expect significantly higher free cash flow. $56 billion. And 38 for Chevron. So yes, much larger. 56 down to 14.6. If I look at Chevron, 10. So Exxon fell a whole lot more than than Chevron, probably because Exxon's dominance of just pure oil versus Chevron's got a little bit more diversified portfolio. But same thing, declining free cash flow operations. If I look at CapEx percentage is strong, but a whole lot less than Chevron. And this, I thought was very interesting. When I looked at these two companies on an EBITDA basis, on a revenue basis, I'm like, meh, they're both kind of the same pattern. But here is a big difference. Exxon Mobil seems to be able to generate free cash flow that is substantially less than the CapEx, leaving a margin every single year. If you notice, this number here is only in the mid-70s, whereas prior in Chevron, it's plus 100, 150. So that means that Chevron is having to put a whole lot more cash into their business, both to maintain their equipment and to grow, than Exxon Mobil. And I like that. That means Exxon Mobil has a higher natural cash flow than Chevron. That's really, really cool. Debt payments, really, really kind of small with the exception of this monster borrowing here when they really need some cash. Free cash flow to equity, I'll add those all up. Shares declining just like Chevron. Per share free cash flow to equity. Share price and yield. Once again, yield 5.2. If I exclude this one-time anomaly, you're looking at 4.4. By the way, had you bought this business anytime late this year or late last year, great job. Kudos for you for stepping into a market that was absolutely panicked mode. You should have a very low cost basis. Now that oil has rebounded and possibly going to continue to grow, you can have a very low cost base investment that's going to throw off a tremendous amount of cash flow every single year. If you happen to have bought Exxon Mobil anytime close to the end of the year of fiscal 2021, your free cash flow yield, is 11%. They borrowed a ton here because of this bank. But you think if earnings rebound, and they get back to this other area, you're still looking at a sizable single-digit cash flow yield for an investment for a long, long time. So kudos for you guys for stepping in the market to go do that. All right, this is Exxon Mobil free cash flow. Let's forecast the price. I'll forecast both EBITDA and free cash flow for each of those, give you a forecasted price. Then we'll compare the IRRs together, okay? Okay, behind me is the EBITDA forecast for Exxon Mobil. So what we're gonna do here is when I look at oil and I look at kind of some of the dynamics out there, I think oil is going to go higher. It's rebounded back to 60. I think it will eventually, over this, at least our 10-year time frame, go upwards towards $100 a barrel. And I think that's going to happen both two reasons. One, I think just the natural demand is going to continue to grow, at least for some foreseeable future, until the renewables take over. But more principally, I think it's an inflation play that as the money printing of the US dollar is eventually soaked up into the global economy, the oil price, which is priced in dollars, will naturally have to go up to offset the sheer dollar volume that's out there. So I think that's what's going to cause oil to lift from the $60 to $100. I think that's going to happen over the next 10 years, giving you a long time to go do that to see what I get. And I've reset EBITDA, so I think because oil has rebounded to $60 a barrel, I've set EBITDA as to the 2019 number when oil was in that $60 range. You'll be back at the $29 per share range. This is Chevron behind me. So I pick up at $29 and I grow it to basically the range they were when they were at $100 a barrel in 2012. They were making about $50 billion a year. So I said, look, if oil is going to rebound back to 100, then earnings should go back up to 100. It's an assumption on my part, totally get it, but oil is a wild market anyways. I think that's where it could head over a decade, and I thought that's a long enough time for make that happen. If I buy it at 50 billion, 9 times EBITDA is roughly their average that I was using, kind of excluding the most recent period. You get a $440 billion enterprise value. Subtract some debt, a little cash. I get a market cap for Chevron of $377 billion. Outstanding shares puts a $200 price target out in the future for Chevron, which is a very, very strong forecast for Chevron. Now, the trick here is free cash flow. When I looked at Chevron, and I'm going to show you what I did, one of the things I realized is that they have this sizable CapEx that they put back in their business every year. and I'm not sure that's going to change. So what I did is I took the average for here. If oil is going to go back to $100 a barrel, I'm going to pull the free cash flow that they yielded when oil was $100 a barrel, and that is roughly $35 billion. I then said, over this all long-term time horizon, what is the average CapEx that they had to put back in their business? So I just took the average here times my free cash flow estimate, and they're going to have to put back in the business to grow or whatnot, $33 billion. And when I subtract the two, and I don't deal with debt, I only get $1.8 billion of free cash flow. That's not a whole lot. It's actually very small. And when I divide it by the shares outstanding, I get basically $1 of free cash flow. And that's what I use because I don't know what their CapEx schedule is going to be forever. I don't know how much they're going to have to put back in renewables to shift their portfolio, but it could be very sizable. And if so, that's going to suck up the free cash flow and it leaves basically $1 the entire time. If I apply 2% yield, which is the yield that I got from historical returns excluding last year, I get a $47 price target, which is much lower. So I look at the two. It's currently trading $104 a share. I've got one EBITDA market multiple of $200 a share, and I have another of $47 based on free cash flow. And I think this is showing you the difference between relying on EBITDA market multiples, which is versus going after free cash flow. We always want to make sure you're looking at the free cash flow. That's why I use that one there. I'm using both for this example. You can split these however you want. For my illustration, I'm simply having the difference and saying it's $124 a share because EBITDA is still based on historical market multiples. It's not like completely made it up. It's just which valuation methodology do you want to rely on, one or the other. In this case, for this channel, I'm splitting the difference. Let's take a look at Exxon Mobil, then we'll do IRRs. Okay, so Exxon Mobil, I'm following the same pattern. $30 billion is what they made in 2019. So oil has rebounded to 60. In 2019, oil was around 60. I expect them to make $30 billion of EBITDA. And then as oil grows to about $100 per barrel, they were making roughly $50 billion when oil was at 50, so I'm pegging them there. And I'm giving a 10 times market multiple to the enterprise, to the EBITDA. That gets me a $500 billion company, $500 billion roughly of enterprise value over long term, minus a little bit of debt. It gives me a $482 billion market cap. I've got some shares outstanding, divide those two, and I get a $113 long-term price target for Exxon Mobil. So just like we did with Chevron, I'm going to follow the same pattern for Exxon. So I'm pulling the average free cash flow when they were roughly $100 a barrel. I'm saying, hey, take the historical CapEx ratio that they spend and multiply it times my forecast free cash flow for the portfolio value, and I get a free cash flow to equity of $14 billion, which is substantially higher than the $1 billion of Chevron. And when I divide it by shares, I get $3.46 of free cash flow long term. So what I do is I put that here long term. So I'm saying they're going to rebound to roughly 260. I don't know, it's kind of a guess. And then over time, they're going to grow to my long-term target of $3.45. I apply an average yield to that, and I get $78 of a long-term share price for ExxonMobil based on a free cash flow method. Now, when I put those two together, I've got $62 as an average price right now for ExxonMobil. I've got two values. I've got $78 for free cash flow, and I get $113 for an enterprise market multiple. I have the two, and I get $95 for a long-term return. Okay, now let's look at the IRR. Okay, behind me is the IRR calculation for Chevron. And you can see you can buy it currently in the market now for $104. I get the $1 long-term free cash flow yield because a lot of their free cash flow is getting pulled into CapEx, and there's not much there. So I'm in for $104, I get $1, and I'm out for $124. That means a 3% long-term return for Chevron. And I think what this is saying is that this price that the stock market has rebounded to is just too high for where the market is going, unless you believe oil is going to go substantially higher than $100 a barrel long term. I think that's a suboptimal return. So for me, we're going to give it a wild meh at this juncture because it's just too it doesn't have a great risk-return profile for us, right? Revenue is not growing, EBITDA is not growing, not in the long term. Free cash flow is not really there. Debt leverage does pass the test. Is it well priced? No, it's not. So I check one out of all of those boxes. It's not really for us. Let's take a look at Exxon. So Exxon Mobil, a little different story. I can buy it $62 a share. I get some free cash flow, which is nice, and I sell it $95. If I follow the IRR, I get a market return of 10%. So I think what this is saying is that the Exxon Mobil stock is not rebounded as much as the Chevron stock. For me, however, I'm still going to give it a meh, because I think there are better returns out there. If you bought the stock at the drop, great job. You picked up huge value. You've received a lot of growth in the stock price recently, and your cost basis is low. So this free cash flow yield for you is going to result in a higher return overall because you bought in a whole lot smaller dollar amount. If I were to cut this in half and say, I don't know, $30, I forget exactly what it was trading for, but let's just say you bought it for half of it, you're at a 22% long-term IRR, doing nothing else. So hang on to it. Don't sell it. Let's continue to let it click along for a long time, and it'll probably do very well for you. But buying in now, for us, I'm a meh, because I think there are other opportunities out there in the market that give you a higher likelihood of beating the market without having to play a commodity play like oil. Let's do the 5 key attributes for ExxonMobil. Top line revenue growth, no, it does not meet it. EBITDA growth, no, it does not. Strong free cash flow, yes, check the box. Low debt, yes, check the box. And well priced, yes, I will give it check the box, because it is a market return. It is well priced. It's not too expensive like Chevron was too expensive. But for me, it's still not exactly what I want. And the job of us is to be subtractive, not additive to our portfolio. We want to look at everything, and only the very, very best get passed and get our money. So that's the way I try to approach it, and I hope you guys approach it the same way. This is Rational Investing. Thank you very much for watching the channel. This has been ExxonMobil and Chevron, the battle royale between the two oil giants. If you want to learn how to do this work, how to have this Excel sheet, how to read a 10K, how to fill in this metrics, I do teach a course. It's at cashflowinvestingpro.com. You can check me out, where I give you a 6-unit, 3-hour course that details how to fill in the sheet for almost any company, how to think about forecasting, how to think about market multiples, and how to think about an IRR, so that you can go find the few stocks that really, really satisfy what you're looking for and go make that investment with some confidence. And again, I'm challenging you guys to go out and read 10Ks for yourself. If you were to read a 10K a week for a year, not doing any investing, just read the 10Ks for a year, you'd have what, 50, once a week you have 52 10Ks that you read. That's 52 companies that you had a really detailed understanding of. And then if you looked back, you could pick one of those 52, and that would be a phenomenal investment, because your spectrum would be amazing, that you could then compare one company to the next, one management team to the next. And if you did that when putting it into my forecast using my train tool, that's a really leg up rather than just guessing blindly because some guy put a line on a colored line and said, oh, the stock's above some 200 moving day average. I mean, what does that really mean? Sorry, I don't mean to ramble, but I can't stand technical analysis. Let's buy free cash flow. Let's be wise with our money. Let's get rich slowly, like I like to say. Thank you very much for watching the channel. I appreciate it. Give me the comments, what else you'd like to see next. My name is Cameron Stewart from Rational Investing. Thank you very much.